Thanks for tuning in and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy and I'm Senior Analyst for ETF.com. This week I'm talking with John Davi, who's the founder of Astoria Portfolio Advisors. John, great to have you on the show.
Yeah, thanks for having me.
John, I'm really happy to get the chance to speak with you because you just launched the Astoria US Quality Kings ETF, ticker symbol ROE. Great ticker. What differentiates this ETF versus the other quality ETFs that are already on the market?
I think the key difference for us is that we are going to pick 100 of the highest quality stocks in the broader US large and mid cap universe, filter down to we get 100. We're going to equally weight the stocks, and then we're going to sector optimize. So if tech is 28% of the large cap, US universe, we're going to have 28%. But, Apple and those type of technology stocks are going to be capped at 1%, whereas other quality ETFs will have, 4 or 5% weight in Apple, let's say, or, they're not equally weighting it.
So John, obviously equal weighted ETFs tend to outperform when gains in the market are distributed across many more stocks than just the handful at the top. Do you think we're poised to be in that type of market environment where we see a broader rally?
I think this was the impetus for us to kind of launch ROE, is that, we're a sub-advisor on behalf of other financial advisors, and we use a lot of index-based ETFs and smart beta ETFs, and we were getting very uncomfortable with the exposures we were getting from just, those few select technology and consumer, discretionary stocks. So at the end of the day, we said, look, we like these stocks. We think Apple's, a fantastic business, but we rather cap it at 1%. And oh, by the way, over long periods of time, as long as markets, are behaving well and the economy is doing well, you get a broader participation. So here's the one stat that I don't think people understand or realize, is that the RSP ETF, the equally weighted S&P, has actually outperformed the S&P 500, since 2003 when it was launched. And even if you go to the underlying index, which there's an index, the S&P equally weighted index, which goes back to 1999, I mean, there's substantial outperformance, over the last, 20, 25 years. So equally weighted does work. And here's another one I have for you. Even the Dow Jones Index, DIA, that has meaningfully outperformed the S&P 500 over the last 25 years. So there's other ways to weight stocks in the index, to pick stocks. I think the lesson I've learned after investing for 25 years is that, keep your costs low, stick with the strategy, and, let time play out. And those are very difficult for a lot of humans to do. But that's really, I think, what sets us up well, with our ETF.
Absolutely, absolutely. And when it comes to deciding what quality is, are there various ways to go about doing that? I know a lot of people look at cash flows, some people look at balance sheets and things like that. What are the different ways to do it, and why do you think the way ROE does it is the best?
Very good question. For our fund, we're looking at, obviously quality and a lot of the traditional quality metrics like ROE, ROA, return on invested capital. There are a couple other factors that we will incorporate into the screening process as well. Things like valuation, dividend, the ability to pay dividends, the sustainability of those dividends, and then growth and momentum too. So it is like a little bit of a multi-factor approach, but it's dominated. The weight is, quality. So, a lot of other quality ETFs, they will use similar metrics, ROE, ROA, low debt to equity, low leverage, dividend is a component. I mean, there's so many of them, I couldn't possibly talk about all of them. But the real key distinction is the fact that we're going to optimize against the sector weight of the large cap universe. So if 28% is in tech in the large cap universe, we're going to have that. But, really it's just that 1% allocation. So it's 100 stocks, equally weighted, sector optimized, high quality.
That's great. And this ETF seems to be resonating with investors. It already has over $50 million in assets under management. Have you talked to investors who are putting their money into this fund? What are they saying?
I think so much is being made about the Magnificent Seven stocks and how much they make up. And, you start seeing in the last couple of weeks, there's been a backup in rates, a lot of treasury issuance, not a lot of absorption of that issuance. So rates have gone up. It's like back in last year, where backup in rates, tech stocks are under pressure. There's a lot of crowd in like index beta ETF, Qs, a lot of the smart beta ETFs, and they're being under pressure. So a lot of advisors we talk to, yeah, they get it. They're like, okay, you're going to equally weight it. You're going to cap each stock's weight at 1%. You're going to distribute across, 100 stocks. So people are resonating. It's nice, obviously, to see quick adoption, but yeah, I also don't think that we launched it just to play like in the next quarter or two. Like we think over long periods of time, equally weighted in high quality stocks has demonstrated success. So what we're telling people, like, use it as a complement to your qual, your RSP, your SPY, your IVV, your VOO, whatever quality ETF you use, DGRW. We think using it as a complement because it's very unique. There's very little overlap by definition because we're capping at 1%. Very little overlap between our ETF versus the other quality ETFs.
Awesome. Well, this was a great discussion, John. Thanks so much for taking the time and sharing your insights with us.
Thank you.